Hi, welcome to the Crypto Republic. Before we dive in, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. What if I told you that every single financial meltdown in history, whether it's ancient empires collapsing under the weight of silver, the Great Depression of the 1930s, or the housing implosion of 2008, follows the same four warning signs? Roman coin debasement 2,000 years ago, or in meme stocks in 2021. The setup is always identical. Four dominoes, four signals. And once they line up, history shows us the crash is unavoidable. What's the scariest part? Some of those exact signals are flashing right now, which means the next downturn isn't some far-off event. It might already be quietly taking shape beneath our feet. That's why this video is so important, because it's not just about dusty old history books. It's about your money, your retirement, your investment, and your ability to see what others cannot. This isn't financial advice, it's financial history. And by the end of this video, you'll recognize the four signs that always appear before a crash, so you're never blindsided again. But before we get to the digital age, let's roll back the clock. Not 100 years, not 400 years, but nearly 2,000 years to the height of the Roman Empire. Rome in the 3rd century AD was the world's superpower. Roads stretched across continents. Trade poured in from Africa, the Middle East, Asia. Wealth seemed limitless. And yet in the middle of all this prosperity, something dangerous began. Rampant speculation. Roman citizens weren't speculating on tulips or tech stocks. Their obsession was silver coins, denarii. Emperors discovered they could stretch their budget by mixing cheaper metals like copper into coins while still stamping Caesar's face on them. At first, it worked like magic. More coins meant more spending and more trade and more growth. Ordinary Romans believed the empire was untouchable, that the denarius would always hold value. But just like Dutch tulips or dot-com stocks, overconfidence created blindness. By the time people realized their coins were losing real value, trust had evaporated. Prices skyrocketed. Panic set in. And the Roman economy, once the strongest in the world, spiraled into inflation and instability. Sound familiar? It's the same mindset that shows up before every crash. This time is different. In the 1600s, it was tulips. In the 1920s, it was stocks. In the 2000s, it was housing. And in ancient Rome, it was silver. Speculation, blind faith always lit the fuse. Now let's fast forward to the 1700s. Paris, France. The French crown was drowning in debt from their endless wars. Along came John Law, a Scottish economist who convinced France to try something revolutionary, a paper money system backed by a trading company controlling land in the New World. What could go wrong? The Mississippi Company. Shares exploded in value. From nobles to shopkeepers, everybody piled in. French government, desperate for revenue, well, they looked the other way. There were no guardrails, no oversight. The king himself was promoting the scheme. He loved it. For a while, fortunes were made. The champagne flowed in Paris. People believed France had discovered an endless fountain of wealth. But here's the problem. The company never generated profits anywhere near the hype. So when the cracks appeared, confidence collapsed. Investors rushed to trade their paper for gold and silver. The government couldn't deliver. And the whole system came crashing down in 1720, wiping out thousands of families. Why did this happen? Well, because regulators, those in charge, either failed to act or acted far, far too late. That's the second pattern before every crash. Weak or absent regulation lets euphoria spin out of control. And when reality hits, it's too late. Okay, now let's jump to the 1990s, the dot-com boom. This was the age when the internet went mainstream. Suddenly, every company with a .com in its name was treated like the next industrial revolution. Investors didn't care if the business had profits or even revenue. All that mattered was a catchy domain name and a dream. This was financial innovation at full throttle. Venture capital flooded startups. Wall Street packaged internet stocks into new funds. Analysts promised the old rules that, well, they didn't apply anymore. But here's the truth. No one really understood how to value these businesses. It was new. It was shiny. And everyone assumed it would only go up. By 2000, the bubble burst. The NASDAQ fell nearly 80%. Companies worth billions evaporated. Pets.com, Webvan, countless others, well, they disappeared overnight. And this is the third signal before a crash. The rise of innovations so new and complex that no one, not even the experts, well, fully grasped them. In the 1980s, it was portfolio insurance. In the 2000s, it was mortgage-backed securities. In the 1990s, it was dot-com startups. And today, this brings us today. Well, today, it could be AI-driven trading or decentralized finance products promising impossible yields. Well, finally, the fourth and deadliest pattern, well, this is debt. To see this, we go back not to Wall Street, but to Asia in the late 1990s. The Asian financial crisis, countries like Thailand, Indonesia, and South Korea had taken on massive debt in foreign currencies to fuel rapid growth. At first, it seemed like a miracle. Highways, skyscrapers, and booming cities. But when global investors pulled out their money, currencies collapsed. Suddenly, debt that seemed manageable, well, that became impossible to repay. Millions lost jobs, entire economies fell into chaos. Debt is the accelerant that turns a downturn into a disaster. Without it, bubbles deflate. With it, they do explode. And that's the fourth domino. When debt piles too high, whether it's governments, corporations, or households, it doesn't take much to topple everything. Okay, ladies and gentlemen, let's put this together. Four patterns show up every time, okay? Speculation, overconfidence. Oh, this time's going to be different, they always say. Regulatory failures, rules too loose or too late. Complex innovations, shiny products no one truly understands. Excessive debt, that fuel that burns everything down. History doesn't repeat word for word, but it rhymes. From Rome to Paris, from the dot-com boom to 2008, the rhyme is the same. So the question is, where are we today? Are investors piling into assets they barely understand? Look at meme stocks, NFTs, or AI hype cycles. Are regulators struggling to keep up with digital assets, AI, and shadow banking? What's the shiny new innovation? Could it be decentralized finance, algorithmic stablecoins, or AI-driven trading? And most importantly, where's the debt? Governments at record deficits, consumers maxing out credit cards, corporations rolling over trillions in loans at higher rates. The signs are here. The dominoes are lining up. But here's the good news. Knowledge is power. Crashes create fear, but also opportunity. Every downturn in history has minted fortunes for those who were prepared. Don't just ask, will there be a crash? Ask instead, when the crash comes, will I be ready? Because wealth isn't built in the boom. It's built in the crash by those who saw the signs. This opened your eyes. Smash that like button. Leave a comment with your thoughts. Turn on notifications. Ring that bell. Most importantly, subscribe to the Crypto Republic, bringing you the truth about XRP, global banking moves, and the wealth transfer already unfolding. Don't just watch history happen. Stay informed, stay ahead, and stay in the Republic.